Hello, I'm Deborah Malone, founder of The-Internationalist and host of Internationalist Marketing TV. And today's guest is Brian Wieser, the Global President of Business Intelligence for GroupM. Brian, such a pleasure to connect with you again. And I think in the spirit of 2022, we can officially call you an optimist because your 2022 global ad revenue forecast shows tremendous growth. I think the kind of growth we used to see years ago in those Olympic years when they were quadrennial, and I guess now also the World Cup years, which are still quadrennial, and 2022 is hosting both, or the kind of growth we used to see in presidential election years in the US. But I believe you're seeing growth well beyond sports or political ad spending. So tell us why we should be optimistic.
Yeah, well, and again, I like to think of myself as objective rather than an optimist or a pessimist, but my numbers can definitively be interpreted by sellers of media inventory as optimistic, if nothing else. And I am on that basis far more optimistic about media now than I probably ever was. And again, I'm to be clear, this is not talking our own book. This is talking about the ad revenues generated by media owners, which are separate from agency services. So how services performed is separate, if you will. The reasons to be optimistic, as you characterized it, actually have nothing to do with Olympics or World Cup. I actually am now of the view that there basically is no such thing as a quadrennial effect. It used to be a thing, but I dare anyone to look at the data, and if you didn't know that the Olympics or World Cup were occurring in a year, to actually see it in the data, you really can't. You can see that at the individual network level or seller of inventory, but at a medium level or an industry level, you cannot see it. And that's because I think that the money for those events is being funded from annual budgets, and it's just getting shifted around. And that maybe speaks even more to the strength of 2022, where you're coming off of what was already an absurdly high level of growth in 2021. And, you could argue our expectations for growth are maybe conservative in some ways, but they're more robust than a typical pre-pandemic kind of year, whether you're looking at the US or looking at the global marketplace. And I think it's largely because the factors which drove the remarkable outperformance of 2021 are probably persisting. And we pointed to three sources of growth that we think are driving this. Primarily, it's massive pools of capital funding venture funding companies at a very large scale, companies paying hundreds of millions, if not billions of dollars a year on advertising in some cases, that are not showing any signs of slowing down, and the pandemic arguably supports their growth in many cases. You have manufacturers from China who are spending money abroad. We don't know how much that's contributing to the growth, but it's sort of a dark pool of money that it's hard to identify. It's probably benefiting Amazon. It's probably definitely benefiting Facebook, but we don't know how much it's impacting the market. And then you have just rapid growth of small businesses, which persists. For the sake of the audience that probably is primarily listening here and the client base that we primarily service, those entities aren't really represented in this growth that I'm talking about. And so that's really an important point, because just because the world's largest brands are behaving normally, for lack of a better word, maybe they're spending at mid-single digit levels, they're playing in a market that's growing faster. And that's an important point, because competition for audience attention is elevated at a minimum.
No, it's very interesting that you bring that up, and it raises quite a number of questions for me. I know that before I go through all those questions, let me just back up a little bit, because you often talk about how the pandemic has been a catalyst for growth in terms of ad revenue. Why don't you elaborate on that just a bit, and then I want to get back to those 3 points about where you're seeing the growth, because I do find that fascinating. So
Yeah.
again, growth despite a pandemic.
Yeah, and some of it may seem counterintuitive on its face, and certainly, going back 2 years ago, we were hearing the first reports out of China, and in my role, trying to anticipate how the global advertising economy was going to evolve, we're thinking, this looks bad, and then you see the first cases in Italy, and you think this looks really bad, and then the case north of where I am in Washington State, it's like, okay, this is going to be very bad. And then it was just a case of, will it be an advertising market will the economy be worse than the global financial crisis or worse than the Great Depression? And we kind of settled on worse than the global financial crisis and presumed advertising would follow suit, right? And as measured by GDP as a metric for economic activity, it was in between those two in most countries. Actually, in the UK, it was the worst economy since 1707, I believe.
Well,
But advertising absolutely did not follow suit. And we could see this within a few weeks of the pandemic. Sure, every large marketer paused everything they could as soon as the declaration of global pandemic was made. But we could see in the results from Facebook by, what was it, the third week of April of 2020, that this was not going to be anywhere near as bad as we thought. And the fact that smaller businesses in particular could operate without any real estate costs, that they were almost certainly operating or able to operate at a national level, if not international level, could still mail things, that they were going to have a digital presence, maybe spend more as a percentage of their revenue on advertising than the businesses that came before them. That's a factor of the pandemic that probably contributed to some of the outsized performance of digital advertising in particular, and therefore then advertising in total. That's the first thing. The second thing is the pandemic caused lower interest rates as governments took pretty bold action at that time, which I don't think I fully appreciated initially. Maybe a lot of people thought it was kind of unnecessary, but hey, it's better to do so than risk an actual financial crisis. If you remember back to those days, people were really worried that liquidity would dry up. So it was a necessary move. But because interest rates and cost of capital remained so low, it meant that public market investors and private market investors are chasing revenue growth at any cost because the cost of capital is close to nil. And you know that your valuation will be rewarded if you see revenue growth independent of its costs, whether it's capital or operating. And that led to marketers in these emerging spaces spending an awful lot of money on advertising. So that's been a factor that's been positive as well.
It's very interesting because not only is that small business, but as you say, emerging. I know that you're also bullish on direct to consumer companies, those D2C companies that have also been a big growth factor in these times. And I'm curious about what percentage, and that might be a hard thing to tell, but are these small businesses and direct to consumer companies. And just a couple of other things came to mind very quickly. I mean, there's so many legacy companies now that also legacy brands that also have to think direct to consumer, not only because of direct distribution, but also of first party data, and so on and so forth. That it's interesting to see. I assume you'll think that continues as a growth sector, and I'm curious as to, is that spending largely digital, or are some of these brands also moving into television or other media? I mean, a lot of questions there, but I think they're all very much related. Yeah.
Yeah, I think it all depends on definitions.
Mhm.
To the questions. I mean, what is direct to consumer at this point? I mean, the idea that a manufacturer may use internet or digital-based channels to and avoid the use of a third-party retailer. Sure, if we call it that, it's hard to quantify how big that is if we're talking about the whole sector. The Warby Parkers of the world, if that's what we're talking about, are actually pretty small. If you just roll all of those traditional D2C models up. It's not a large share of the total advertising economy. But when you broaden it to say include app-based developers, which sure, they have direct consumer models. So think of food delivery as an example. And that's where a lot of the battle is going on right now for consumer attention and for advertising inventory attention. I mean, we're talking many hundreds of millions and sometimes billions of dollars of annual spending right now at a global level from these individual companies in some cases. So I think that it can be very large. When we think about how larger manufacturers are operating and evolving, certainly they're all trying to find models that involve selling directly to consumers where it makes sense. In some cases, they're investing in entities that provide those services. And in other cases, they're just trying to support their partners who are retail distributors, essentially. So in the food category, for example, where rapid delivery hasn't taken off, as in the United States, it's still very, very early. If you're in most food categories, you realize that the direct consumer model probably isn't as effective as it is in, let's say, I don't know, vacuum cleaners. There are going to be some categories where direct consumer model will work better than in others. But with that said, if rapid delivery takes off nationwide in the United States, then you might see a greater investment. But again, this is a third-party model that we're still talking about. It's just a different third-party model. So what is direct-to-consumer anyways in that context?
Well, it's interesting in the way it might shift the way that we think about those brands that are among the larger advertisers. That's what I think is interesting.
Yeah, there are several multi-billion-dollar advertisers out there now that didn't used to exist. And some of them don't even have much of a consumer presence. App11 is probably the best example. I mean, there's somewhere between $1 and $2 billion spending on advertising.
Who is that again? I'm sorry, who is that?
Right, App11.
Oh, yeah.
And so certainly in mobile gaming and related adjacent sectors, there's a lot of spending going on. And that's also contributing to the growth that we're seeing. Wish, although it's struggling at the present time, it was certainly on pace to be it was a multi-billion-dollar advertiser last year, and I think that there's many other companies out there that are like them, that some of which are private, and we just don't even have data on.
Well, that in itself is quite remarkable, but you mentioned something earlier, and I just want to dig a little deeper on it. You were talking about the ad sellers, the sellers of advertising. And I think one of the statistics that you've mentioned is that several years ago, I think it was 2016, the largest sellers of advertising represented 46% of the total amount of advertising. Now in 2020, they're 66%. So that's a pretty significant jump in a few years. So is it that the big are getting bigger and we're going to continue to see that, even with the rise of some new media like TikTok and so on?
Yeah, and the data that you're pointing to, it's certainly been in excess of 70% last year and probably pushing towards 80% this year.
Wow.
The trend that's happened, I mean, it is remarkable, exactly as you said, like in such a short period of time. Like in 2016, we were talking about how concentrated the media industry seemed. Mm-hmm. And it's substantially more concentrated now if you look at the data at a global level. And that is the critical point here. An analysis I haven't done yet, but which I aim to do, is to lay out what did media concentration look like in a single country, such as the United States or the UK, in 1990 or 2000 or 2010. What I think you'd probably find is that in the United States or the UK, the top 20 sellers of advertising probably represented 70% of advertising. And that's probably true in most countries on earth. What's different now is that it's the same 20 companies with one or two exceptions. That is a big difference. It is the globalization of the industry. That's one of the most important trends that's been happening that we're here with the Internationalist. But it's well illustrated by the idea that 30 years ago, 40 years ago, you were a small business. You are physically constrained for most of your operations. Who are your sources of advertising inventory? Your local yellow pages, maybe your local newspaper. If you're spending only $1,000 to $10,000 a year, that's probably all you had access to. Fast forward to today. Who are your sources of ad inventory if you're that small business with $1,000 or $10,000 annual budget? Google, Facebook, and if you have an e-commerce-based model, Amazon. You are operating nationally or internationally now. In some ways, it's not different. You could argue even that there's more competition. Now you have 3 places you might spend money, not just 2 for with that kind of budget. Now, we could still argue that that was always too much concentration, and it's still too much concentration. But I think that historical context and the global trend is really important to point out, because the advertising market has become incredibly global in a short period of time, and in a way that I don't think people appreciate it. We also showed some stats in our June this year, next year release. I think we included it at the time, where I characterized that in 2010, if you looked at the 5 biggest sellers of advertising in that year globally, it was Google, which might have been number 1 in most markets outside of China, followed by, I believe, Disney, Comcast, Viacom, and News Corp. And the issue is that then numbers 2 through 5 were almost entirely US based in terms of their advertising revenue. Sure, News Corp had UK and Australia, but basically most of the ad revenues those companies generated came from the US. And together, those were the 5 biggest globally. Now, the 5 biggest sellers of advertising would be Alphabet, Google, followed by ByteDance, as in TikTok's owner, followed by Alibaba, followed by, Facebook would be number 2, and Amazon would be number 5. And Google, Facebook, Amazon numbers 1, 2, and 3 in most markets on Earth. So that's a big difference in how this concentration has evolved too.
Now, I think that also you mentioned going back in the research you wanted to do to look at the US or UK and look at some of those media concentrations. I also think that if you look at some other markets that we used to term the fast growth markets, they also leapfrogged a tremendous amount in terms of technology, which, whether it was mobile or whatever it might have been. So they probably went to some of those those global platforms even faster.
Well, yeah, yes, but I think that actually the concentration levels might have actually been higher before, because you might have, and it really depends on how you're looking. Are you looking at it through the lens of the overall economy? And then is that even meaningful? Because you have at least 3 segments of marketers, as I see it, in almost every country, right? You have large nationally oriented brands, maybe part of global conglomerates or competing with them. You have small businesses, and you have something in between, which I would generally characterize as performance-based marketers, which exist everywhere in different forms, whether that's an app developer or whether that's a catalog-based entity, as it might have been the case years ago. However you want to look at the world, you do need to segment the market, and then you can start to look at concentration through the lens of that kind of a marketer. Again, from our vantage point, we are focused on global marketers. Concentration is much less of an issue. In fact, you could argue that more players operating globally is a good thing. It actually is fragmenting the market in a way that's helpful. Because now, if you're a globally oriented marketer, you can realistically start to think about your global relationship with Google, with Facebook, with Amazon, with Snap, with Pinterest, with Twitter, with Reddit, yes, with ByteDance, and so on and so on and so on. And as the US-based TV network groups are now establishing themselves more aggressively, really for the first time in some cases, as international sellers of content direct to consumer with their streaming services, while they may never have the same level of advertising that they presently have, they may have some of the most impactful advertising in some markets. And so those global relationships will be more important than ever. So that's actually a good thing for globally oriented large marketers, such as the ones we tend to work with.
Well, even though you've just mentioned television, it sounds like the growth in media will continue to be digital first.
Oh, absolutely.
So what does that mean, about the metaverse? How do you measure that? And, what happens going forward? Or is everything simply digital media?
Well, the meeting starts to become pretty irrelevant pretty quickly. We shortly after I joined, we started to break out more formally internet and digital media from one single line item to have several, where we would try to attach the digital extensions of traditional media into the traditional media line items, because it's kind of not meaningful to look at connected TV plus, as we call it, or the digital extensions of traditional television as something that's part of internet advertising, unless you're in the business of making servers. I mean, from that vantage point, sure. But from the vantage point of a marketer, it's much more relevant to continue to think of that inventory as television: sight, sound, and motion, premium content, focus on reach and frequency. And so, yeah, digital forms of traditional media will continue to grow in importance. Now, with that noted, pure play digital platforms such as, again, Google, Facebook, Amazon, increasingly important, but they're increasingly important not primarily because they're capturing a growing share of spending by large brands. Collectively, all of them are, but that's pretty incremental. The big change, or the big issue, is that they're growing because they are contributing to the growth of new kinds of marketers, or capturing the growth from new kinds of marketers who never or wouldn't historically have started with television.
No, that is very interesting. And these shifts can be pretty fundamental in terms of how we think about the business going forward. And speaking of that, I think that you've said you believe that all media spending will surpass $1 trillion by 2025, which again is another big leapfrog from where it is now, where it was 750, 760, something like that, 750 million now. But is there anything that would derail that kind of growth?
Sure, there's plenty of risks. The single biggest risk that I point to, that I think is a plausible risk, is that capital markets fall apart. And I'm not saying, well, right, but I'm not saying they will. Oh, and when I say fall apart, I mean cost of capital rises dramatically because interest rates go up, or something else happens that causes more discipline in investment in early stage but large scale companies. And that's not the same thing as saying the stock market's going to fall, or not even. Those two things don't necessarily happen at the same time in the same way. But what I mean is that the tolerance among investors to support long-term growth paired with massive losses and massive cash needs in the near term could change. And that's among the risks that I could see. That's probably the most likely. I'm not saying it does happen. We don't explicitly assume it happens, in fact. But I would point that out. I mean, sure, the pandemic going on is a risk as well, but you could also look at it as a growth catalyst yet again. So maybe it's not a downside risk, but it could be.
Right. Or it's just an endemic that we manage around.
Sure, but there are risks associated with that maybe that long-term consequences of that have some negative impact on advertising. Supply chain issues, maybe they never really get fixed. Inflation as a general thing should be positive for advertising based on how marketers tend to budget for it, but inflation can cause friction in an economy. When you get friction in an economy, that's what causes a downturn. So there are plenty of things we could point to that could cause numbers to go south, but our baseline forecast is for somewhat elevated growth. Elevated meaning relative to where growth has been in pre-pandemic times. you have to imagine getting back to normalcy. Normalcy meaning more like on the lower end of a mid-single digit growth range, just because if you keep growing faster than anyone might expect an economy to grow, eventually you become the economy. And as far as I'm concerned, I don't think advertising becomes the economy anytime soon.
Well, hey, you never know. We've had a lot of surprises. And speaking of speaking of surprises, was there anything in 2021 last year that was kind of a surprise for you, or that you hadn't anticipated? That those things are always kind of interesting to look at, if they occur at all.
Yeah, I mean, frankly, the surprise was just how fast the advertising market grew. I mean, the forecast we published back in June felt uncomfortable in the sense of this feels like a really strong rate of growth. The 2-year growth rate, 2021 over 2019, would be historically high if this forecast plays out. And yet we're still in the middle of a pandemic. And yet we exceeded it substantially. And so we raised our numbers yet again. And this was true not just in the US, but also in the UK and many other markets. And so it was just a continuous outperformance for reasons we still don't fully understand, right? I've walked through my theories as to why all this extra money is flowing around the advertising market, but because I think our handle of what those sources are is still so tenuous, maybe it remains that we can be easily surprised.
Well, in some ways, that might be nice to know that as human beings, we there's still some things that we may not be able to anticipate. I don't know. Let me ask you another thing. Was there a country, any countries in particular that either surprised you, or you were just amazed by either their growth or lack of? Yeah.
Well, China is interesting and maybe a little bit surprising given how the pandemic has played out there. It was actually the one market that where we brought down our numbers slightly in the December update relative to the June one. Now, to be clear, if you're growing at 19%, that's pretty strong by any global standard, but it was below where we were in the June forecast. Only a few percentage points, but that was the opposite trend from what we saw almost everywhere else, where expectations went up. And this is, we think, more a function of just the Chinese economy decelerating. But still, it is an interesting point that success in the pandemic is not necessarily success defined as low case counts, is not necessarily correlated to advertising growth, let alone economic growth, let alone acceleration or deceleration. In some ways, it's kind of random.
Well, I would still think it's pretty much tied to consumer demand for certain products, not even.
To grow or decline should be viewed as factors which are likely to contribute towards more or less growth, all else equal, ceteris paribus, as the economics kids might like to call it. But it's not the only thing. And I will argue to my dying grave that creative destruction is the factor that causes advertising growth. Everything else is just a proxy for it. Creative destruction in the Joseph Schumpeter sense of the word or phrase, meaning new businesses evolve to replace others which go away, is a natural way of being in capitalist economies. And if you have new businesses forming who have higher advertising intensity relative to those which were effectively replaced, you get growth. And if you have an economy forming businesses who are less prone to advertise relative to those which they replace, you have a decline in advertising. You can have a growing economy and a shrinking advertising market for that reason. And the opposite is true. You can have a declining economy and a growing advertising market. The pandemic proves this out. Nothing else ever did. That you still had, take the UK again, worst economy since 1707, and you had a basically flat advertising market. The fact that the economy was weak, sure, that probably pulled down the numbers a bit, but there's so much creative destruction going on. And that's what's causing the relative health of the advertising market to hold up. So yeah, it's not just about consumer demand. Consumers are part of the factor, but because consumers aren't the ones buying advertising, what they do is not the driver.
But they are buying the products that are advertised, or perhaps one hopes.
Sure, but it's interesting. I long ago I realized that I was not a student of consumers, but I was a student of corporate behaviors. And as we all know, corporations are people too. And corporations make decisions in ways that are informed by, but not driven by consumers. We could argue they should be, but let's separate our preference for what should be from what is. And what is that corporations make decisions based on a wide range of factors, which often don't have anything to do with rational choice.
Oh, very interesting. You are always, we could spend hours just talking about so many of your theories and also your insights into just, as you say, whether it's corporate behavior or media, or how advertising is spent, or views of a globalized world. However, I think we might have to start to wrap this up. So I will ask you a final question, which may not be an easy one, but for 2022, is there one word or perhaps phrase that you believe will characterize the coming year?
Resilient.
Okay. And I know that you're objective, neither optimistic nor pessimistic, so I didn't expect optimism, but resilient. So you just think that we've all learned.
Moving. We keep pushing forward.
No matter what.
Yeah, and that doesn't mean that advertising always goes up or down, and arguably that shouldn't be the goal. But I think that businesses, as with people, non-corporate people, that is to say, do continue to find ways to move forward in whatever that means.
Well, yes, thank goodness for the human condition, and that we are built to endure, or at least I think that's a little bit of obscure Darwinism, but whatever it might be. But if anything, I just must thank you just tremendously for taking this time and sharing these insights, which are tremendously rich. And I do think that many marketers around the world will not only benefit them, but I think it will help them put some things in perspective. So thank you so much. And let's hope that we can talk to you more than annually.
Yeah, absolutely. Thank you very much, Deborah. Thanks for having me, and thanks everyone for listening and watching.
A pleasure. The Internationalist focuses on the continual reinvention of marketing by highlighting inspirational marketers around the world and their ideas as they move the industry forward. Internationalist Marketing TV shares these perspectives through interviews and personal stories.